Now, Australian banks have felt the impact of Moody's global review of the credit ratings of hybrid securities issues. The major banks have revealed to the market downgrades to the ratings of their securities. And joining me now to talk more about this move and the impact on the banks and investors, Jim Stening, Managing Director of FIIG Securities. Jim, welcome to you once again.
Thanks, Bob.
Firstly, why have Moody's downgraded the bank hybrids?
Okay, well, it goes back to what we experienced through the GFC. Prior to that event, these structures were obviously promising to pay coupons. One of the tools that the regulators used, particularly in Europe, was to force banks or issuers to stop paying distributions. So that's a fundamental part of a rating or a rating agency's review is that's an obligation to pay these distributions and also to repay principal. So the likelihood of that happening as a tool going forward, regulators are prone to do that, so that has an impact on the ratings going forward.
So they've changed the methodology, part of a global review, and
That's
it's only
right.
just now hit our banks, or some of our banks?
That's right. No, it's all encompassing.
Yes.
It's the banks, definitely, yeah.
Yep.
But the major banks are the big users of that market.
Yep, sure. Do you, well, firstly, why should we listen to Moody's, given the global
I suppose,
crisis?
That's a fair point. I guess, they're responding to events or actions that occurred that were unforeseen, so I suppose that's a good thing in that they're changing their models because of what's actually happened.
Do you care less than before about?
Well, I think what's interesting is that these type of hybrid investments are akin or very like equities, so it's important, I think, to reflect that they are high risk investments. It's interesting because Standard & Poor's obviously haven't applied the same methodology, but that's not to say that may happen down the track. So there's a bit of a divergence in terms of the analysis.
Okay, and did you agree with the decision then, I suppose is the question as well?
Well, we have our own view on the security of these assets. I suppose I think it's probably it probably does reflect more how these things will behave in terms of global financial crisis.
How have the investors actually been impacted then?
Well, I think one key factor here is that S&P haven't adjusted. So as far as investment mandates that are rating based, it hasn't meant that people are forced sellers. And I think that sort of saved any sell-off on the back of this news.
What about sort of the pricing of the hybrids? Did you see a reaction to these downgrades?
Well, I think this is something that's been flagged for some time. So this is really effectively the rollout of what was expected. So there have been some nerves. This was announced, I think, originally in June, then later on last year, and now it's actually crystallised. So we've had a little bit of time to prepare. So it certainly hasn't added to confidence, let's put it that way.
And to be clear, all other ratings and outlooks for the banks, that's unchanged?
That's right, the senior ratings, that's right.
Okay, can I ask you about the rate rise this week, but particularly the reaction of the banks? And we saw all the big banks come out to move in line with the official rate rise. So I guess from a home mortgage owner's point of view, that was a good thing.
Yeah.
Have bank funding costs changed for these banks, though? What's the deeper story for these banks?
Well, I mean, certainly the short-term money market, the term deposit market is extremely competitive and very expensive for the banks. Term funding or bond issuance has actually come down marginally over the last 3 to 4 months, so things are starting to improve there.
Okay.
But
so has that allowed them to just go by the RBA increase as opposed to going by more?
Well, I think so, and I think also one of the things we saw was less write-offs. So we're expecting effective interest margins to be affected by large defaults and foreclosures and things like that haven't really materialised. So from a political perspective, obviously they're making a lot of money. They're doing very well. So
out of the bank reporting season, we know that, I suppose.
That's right. We've just come through that. So I think this is a fairly sort of sensible approach.
Okay, but to what extent do you think they continue to move by the same amount as the RBA, as we know the RBA will continue to hike?
Look, that's a good question. I think what's happening here is that the RBA is slowly regaining control of the economy after the unravelling of the last few years. So to see that those rates are more in sync with the official movements is very comforting in terms of their ability to control the economy.
And what about about the bond market's reaction to the rate rise through the course of the week?
Well, bond markets have really factored in the entire cycle. They tend to be very preemptive. So at this stage, they're sort of saying that rates are going to peak around 5%, which I think is the top end of sort of general forecast. So if you look out along the yield curve, longer-term yields are a lot higher than shorter-term yields. So what we'll see over the remainder of this year is shorter-term yields approaching longer-term yields. Now that's all well and good. The interesting thing, or the thing that can fundamentally change that, is inflation. And we'll get a reading on inflation in late April. So if that's in line, then you know, longer-term rates or bond rates are probably not going to move too much higher over this cycle.
What's the current thinking on the inflation situation? Given I know that obviously the government announced with the May budget there'll be a cap on the stimulus and that spending, I suppose. So that might be taken into account in the next few months. But obviously the economy's really got a good head of steam already.
Look, it has, and I think, you know, I think the Reserve Bank's conscious of that. They're in this luxurious position where they can sort of, you know, slowly turn up the heat by edging up interest rates. And so I think, you know, if we're sort of being slow roasted rather than char grilled as an economy, if you know what I mean. So I think, you know, they're very much, as I said before, they're regaining control, and that's a very comforting thing. I think inflation, there's nothing to indicate that we're going to see an acceleration to the upside. And
when you talk about the RBA regaining control, you're particularly talking about the banks moving in line as well. That was such a wild card, wasn't it?
Yeah, well, that's right. I think, you know, to a certain extent, credit really hasn't freed up for certain sectors of the economy. I suppose that has to return. There are other things like, you know, securitisation is still closed, so obviously banks will be relying on domestic issuance, sorry, bond issuance and to fund their on-balance sheet assets. And
there's some pretty good rates for particularly online with the banks at the moment with the deposits, isn't there?
Oh yeah, I mean deposits. We've never seen this sort of competition in the deposit market. I think, you know, particularly when you overlay that there's a government guarantee on term deposits at the moment, it's a very, very unusual circumstance.
Can I ask you about Wesfarmers as well this morning? We have had the news come through. It's priced a new 500 million euro bond. The headlines coming off the news media saying they've ditched the local market. They do go offshore historically.
Yeah, they're a
but
regular offshore.
Do you see this as some sort of a snub for the local market at this stage?
I don't think you can read too much into that. I think it's, you know, it's each company has their own sort of I suppose strategies. Interestingly, we saw JP Morgan is pricing an Aussie dollar deal today. So that's the first time a US bank has been issued in Australia, you know, a kangaroo issue in a number of years, and we all know why. So that's a 5-year deal. So it's cheap for those type of organisations to raise debt in Australia due to the basis swap, which obviously a lot of Australian banks are borrowing money offshore and bringing it back to Australia, which is pushing it out. So, I mean, that's an encouraging sign for our market, and I think we're going to see more and more of that over time.
You want to see others testing the waters here from offshore?
Yeah, well, I think we will. I think that hole will develop.
And can I quickly ask you about the $1.5 billion bond issue from CBA this week? Just give us a quick rundown of why they issued these bonds and also what's driving this appetite. We're hearing about this growing domestic appetite. CBA was talking about it, the non-government guaranteed bonds.
Yeah, well, that's right. With the, you know, the government guarantee is no longer around, so they have to stand on their own 2 feet. I think this is a large issue, a large domestic issue. We've seen credit spreads coming in, edging in, so that really is an indicator of demand, an undeniable indicator of demand. So given that it may be expensive to issue offshore, those types of, due to the basis swap, well then this makes a lot of sense.
Okay, thank you so much, Jim Stening. We appreciate your time as always in studio. Jim's from FIIG Securities, Managing Director, and let's cross over to the Australian now in just a